Well, good evening and welcome to this live stream on the 3rd of December 2024. Where did the week, month, year go? I can't believe we're in December and Christmas is just around the corner. I've got a roof to fix before then. It's Martin North here from Digital Finance Analytics. Great to have you on tonight, and I hope everybody is well. And we're going to have an interesting chat this evening with Damien, specifically about some of those issues related to the markets and what's happening. As a reminder, before I bring him in, just to say we don't give specific financial legal advice, general conversation. Please play nice in the chat, but feel free to throw your comments and issues in and questions specifically, and we'll try and answer them. If you use that Walk the World, that'll get my attention and make sure I see your questions. And also, I've enabled Super Chat, so you can put your questions at the top of the list by using Super Chat, or indeed make a contribution to what we do around here. Always appreciated. We do this not for profit, but because we think there's a really important conversation to be had. And with that done, let me bring Damien in. Damien, hello. How are you?
Not too bad. Yourself, Martin?
Yeah, pretty good.
Your roof?
Obviously. Yeah. Oh, yes. Well, you see, when I got this property a couple of years ago, the surveyor said you will need to budget to replace the roof at some point in the next 2 or 3 years because the slates are quite old. And I was thinking, right, well, we've done that. So we've built a sinking fund and we've got to build a lined up next year. And then blow me, we had this massive tree come in and suddenly everything's been brought forward. So we had a water feature that we didn't want to have.
Excellent. Right. So lots going on this month. I think the last time we spoke was like the day before the election, or the
it was just hovering, wasn't it? So we have to talk about the Trump effect, obviously, and we need to talk about what the implications of that are for markets. I mean, markets have been running quite hard. It is fascinating if you think about where the ASX 200 currently is at the minute. We're knocking on all-time highs, really. Why is an interesting question. We might touch on that. Other markets around the world, of course, are also very much up there. But going into the end of the year, some uncertainties, some questions about Trump policy. But I think also important to take a longer perspective as well as to what valuations really mean. And we're going to try and get into some of that today.
Yeah, that's right. Yeah, I'd love to look at some longer term views, because I think a couple of years of 10 to 15% returns can skew what people might think are normal.
Yeah, very good. And it's an interesting question, isn't it? What are typical long term average returns? If you go over the longer term period of time, what is normal?
Yeah, so I like to think of it as 6 to 9 is sort of where I start this from, is 6 to 9%, and I'll get to sort of where we can build up to that from some of the fundamentals. But basically, it sort of looks at around about 6%, certainly in recent decades. The earnings per share growth that you've been seeing. So if you think about it, if you stick a sort of valuation line in there somewhere, whatever it actually is for how much you'll pay for earnings, is that you're getting about 6% growth on average in that, and then you're getting a dividend yield on top of that. So on a global, so we're talking about a global perspective, is that might be sort of 2 or 3%, and so that sort of gives you that sort of 6 to 9%. Some years, if you've got earnings a bit lower, earnings a bit higher. But there's lots that goes into that. And there's sort of financial engineering, and there's tax cuts. That tax cuts make a surprisingly big amount of that company earnings growth. And so I'll sort of dig into that in a second, but I thought it's worth having a quick look at the 10-year expectations for there's a sort of an interesting survey that just came out from a group called NASRA in the US that looks at a lot of asset consultants and a lot of investors about what they're expecting. And the interesting thing was that the average has been coming down, and so the average of sort of expectation of sort of 8 or 9% has sort of come back to more like 7 at the moment. And I've got a chart up, hopefully showing, which has got these bands, which are sort of showing that that the number of people that are expecting a certain range. So, if you look back at sort of 25 years ago, basically everyone, maybe 50% of the market was expecting an 8% return, whereas if you look now, it's probably maybe not quite 50, but it's probably 40% expecting a 7% return, and then sort of the people, there's hardly there's no one expecting an 8.5 anymore, and there's a bunch of people expecting below 6.5% return. So some of that is where you're starting from. But having said that, this is a chart that started in the middle of the tech boom, and so in the middle of the tech boom, everyone was still expecting 8.5%, and it has come down. But there's the change in people's sort of long-term expectations returns hasn't really been affected by market levels, and that's where something I do want to speak about a little bit when we're looking at our analysis. So this is sort of this next thing. Another group sort of looking at this and just looking and saying, well, if you're sort of looking at a 10-year return for the last since 2015, is that around 2015 it was sort of that in that 8% range, and this dotted line is showing what expectations are for some of these surveys, and so it's been 14-15% for much of this last sort of 5 years. And I guess that point they're saying, well, long-term expectations really haven't changed a lot, despite we've had this, we're at 13.5%, growth rate for the last 10 years at the moment. That's interesting on one side. The other one, I want to jump into some of the different asset classes. One of the most sort of I guess I don't know whether you call it shocking, but this sort of fits with I guess my expectation on this, but certainly not with I guess conventional wisdom. Is this is sort of your last 10 years of expectations for commodities, and so we've had sort of negative commodity returns for a long time now, but the expectations are always that you're going to get a 5% return from commodities. Tends to be the expectation from those. So this is looking at commodity indices. And I guess I'd highlight for those that, my take on commodities is there's sort of two elements to it. One element is, what am I getting paid for? And by owning these, and largely what you're getting paid for is sort of like an insurance type return in terms of saying, well, in terms of the futures, this is assuming you're buying some of the futures, is that there's other people out there looking to hedge their bets against it, insofar as it's farmers or miners or whoever it is that's producing this. And they want to make sure they're getting some that they can still keep producing if prices go the wrong way. And so there should be this sort of natural return to investors in terms of saying, yes, you're taking on the risk from the producers, and so you get this return over time. But that return hasn't been there, and the argument, I guess there's lots of different reasons people speculate why. For me, it's largely the existence of a lot of speculators in these markets. Now, for some part, it's been issues with the energy market, but I think by and large, I'd put this down to a lot of speculation. And so there's this idea that if a market which was meant to be a bunch of people getting insurance has turned into a bunch of speculators, then the longer term returns can deviate for quite a while from what you might expect. And and I think there was certainly a big pitch on commodities as China rose, sort of the period in the early 2000s and sort of into 2010s. There's this whole idea about getting this commodity exposure, but that has not been a profitable area to be in, despite some of what you might see in some of the Australian markets. Some of the Australian commodities, in terms of iron ore and coal.
Just one question to Damien. When we talk about those total returns, does that include capital appreciation, or is that the cash flow returns?
No, that's total returns.
Yeah.
On these. Yeah, so all these charts are total.
So that includes capital appreciation amortized over the life, as well as the cash flow returns and the reinvestment of those cash flows as well.
Yes, that's right. Yeah. And then this one, which might be a little bit small to see on yours, and hopefully it's people can sort of get through to what it shows. But this is sort of showing the range of what people are expecting for different markets. And so At the top, we've got US equity, large cap, then small and mid cap. And so there's an expectation that small and mid cap will do better than large cap. I'm not averse to that in sort of a broad sense, in terms of saying, well, the valuations look better, and they've certainly underperformed for the last couple of years. Whether that'll stretch out for the next 10 years, that's always a hard thing to say. And at the moment, it seems as if some of the large cap, they've certainly got a lot of momentum, and a lot of the earnings sort of seems to be accruing there. And also, I think we've got a president now who is less worried about monopolies and trying to protect consumers from larger corporations. And so I do think you might find that large cap companies I wouldn't necessarily write them off in the short term. The more interesting ones. Then you get into the sort of what the expectations are for bonds, for corporate bonds, and for debt. That's sort of that sort of step lower, I guess. What's interesting is a couple of things. Right at the bottom, there's two different ones that are really marked up. One is private equity, where clearly, it's head and shoulders above everything else in terms of expectations. So the expectation is going to sort of do 10% plus, but for a lot of people. And I think that's, to me, that one stands out as being optimistic. I think private equity's had a good 10 years or so, but there's been a lot more capitals come into this private equity space in the last 5 years at least. And a lot of the returns in that is about valuation returns. So, if you can buy this private equity cheap because it's trading on, it's not traded on a market, and so it trades at a discount, and then you bid that price up. So let's just put some numbers behind it. So you can buy stocks on a 7 or an 8 times PE multiple, and the market's trading on the listed market's trading on say 14 times. Is that as people sort of bid up the price of those unlisted assets from 7 or 8 times to 12 or 13 times, and sometimes even higher than what you're getting in some of the listed markets, is that yes, that's a great return for private equity, but that's a one-off. That's a change in valuations. And so I tend to like to come back to the fundamentals. What are you expecting earnings to do? Are you expecting earnings to grow faster for these companies than listed companies? And that's the one where I struggle to see the fundamentals doing better. And I think there's a lot of reasons why you might expect that there might be some valuation reversal at some point in terms of that.
One other question I've got, Damien, one question I've got is, this is, of course, with a given level of inflation expectations as well added in, right? So,
yes.
So this is not an inflation-adjusted return. And you can see in that chart, right, that in fact, as inflation rises, then effectively the expectation improves, which is, of course, logical, but it doesn't mean your fundamental, inflation-adjusted returns are necessarily going up.
Yeah, well, and to put that in context, so this is sort of 26 different advisors, and they're large sort of organizations that are sort of immersers and people like that who are really, trillions of dollars under management. But their expectations is the bottom one, and that's between, the lowest in the survey was 2.2 and the highest was 2.8. So we're not talking about massive inflation assumptions on these. And the other interesting one is private debt, which I always find fascinating in terms of that, that the expectation is you can get a much higher return out of private debt than what you can out of some of the others. And that's true to a certain extent, insofar as, you can get some higher returns. If you know what you're doing, you can get some higher returns by picking up some illiquid assets and things that, banks and others don't want to finance. But I guess the general view that you can get a higher return in private debt, it's almost a bit like a reverse lottery in a way, in that within equities, the idea is you're trying to find the best performers, but most of the equities, if you're buying a cohort of stocks, they're likely to be going up over that period. within private debt, it's about trying to avoid the real losses within it. So you're buying in equities is about trying to get the winners. In private debt, it's really about trying to avoid those couple of losers. And so it's this part where if you're how can I put this one? If you're looking at a big portfolio of private debt, then I think the returns will average out a fair bit lower than what they're showing here. Like they'll be a lot more similar to buying some of the listed debt. And once you take into account all the losses, because there's going to be some big losses on one. But actually, if you're only buying a few of them, if you're buying 5 or 10 of these things, then a lot of them are going to skate through without losses. And so I guess it's that part where you may not be getting a representative sample within it. And so I think you'll find there'll be a bunch of people who make great money in private debt, and there's going to be a few people who are going to blow up really badly because they're going to happen to get the ones, the bad ones. And I like to, it's the analogy of, if you're going to the casino and you're telling somebody, hey, don't put all your money on number 9 on the roulette table, and they're like, no, this is the right thing, and they put it down and they win, and they're like, look, see, you're an idiot. In a way, the private debt's a little bit the opposite, is saying, there's only one number that we're going to lose a lot of. A lot of the time you're going to do fine, but and the more private debt things you take, the more likely you are of getting one of these in such all your eggs in one basket. But yes. Anyway, so I thought that was quite interesting in terms of how they're looking at it. And I thought I'd then compare that to how I then come back and look at these things and give you that build up. So I've got these long-term numbers here from this is from Robert Shiller, who has this thing called a Shiller PE, and what he does is he takes 10 years worth of earnings, adjusts them for inflation, and averages them out, and then compares that to the price to sort of give you this long-term look at how things are going. And you can sort of dig through these numbers. And so this is all for the US market, but you can look at this idea of, I've put on this, each of these is like a 50-year average for each of them. And so if you look at the 50-year average earnings per share growth, so that's where that comes through at that 6%, 6 to 6.5%. And so, yeah, that's great. I can see why equity is going to give me that return, and then it'll give me a dividend as well, which will sort of lift me up. Then you look at the real earnings per share that's come through, and you sort of go, well, that's sort of 3%. So a lot of that's been inflation within that period. Like we had some pretty hefty years of inflation, but I guess that still give you at least some comfort. Is you're going, well, if I can get 3% real earnings per share growth, plus then I get whatever inflation is, say 2.5%. That sort of brings me up to 5 or 6 or whatever it is, and then I get my dividend yield and back off and running. But the sort of the fascinating one is this idea that real pre-tax earnings. So if I take that step all the way back, and I don't look at per share data, I just look at the actual the underlying earnings for these companies, is that pre-tax earnings would often grow above the earnings per share. So they grow, and that was for whatever decades of the early 1900s and into sort of the up until about 2000, and that's when we sort of got these buybacks. Buybacks were often illegal for companies to do before that, and then we've had buybacks come through as sort of this in the 80s really started to pick up. And if you look at the difference between those two, the real pre-tax earnings and the real EPS, this is basically financial engineering and tax cuts. So you've had no growth in real pre-tax earnings for the last 50 years, but because we've had buybacks, which is effectively reinvesting in the companies and getting a return on that, and because there's been tax cuts from 50% plus for corporates down to 21 where they are now, and potentially going down to 15. That's what's really driven a lot of that earnings growth. So in some respects you go, oh well, that's terrible. There's no growth. That's the worst thing ever. And you say, well, in other respects though, you go, well, we've had no growth, but we've got buybacks and tax cuts, and we've got another round of tax cuts coming. there's still some more juice to squeeze out of that lemon, I guess is where he's going. Is yes, maybe at some point you might find that the real EPS growth starts to get closer to that real pre-tax number. But I do think that we've got a while to go before we have to worry about that.
Talking about squeezing the lemon, of course, the other factor in all of this is Trump, right? And in fact,
yes.
Cookie basically threw this in a little while ago, which is, are your guys changing your strategies when Trump gets into office? More cautious, sell, buy? Like to hear your thoughts. So as we sort of segue this forward, clearly the Trump effect is another critical factor to lay in over the top of this.
Yeah, absolutely. And that's basically why part of the reason for doing this is because of this idea that tax the when you look at the market and you look at what the earnings multiples are, and you say, okay, well, if we cut taxes from 21 to 15, and companies don't actually pay that tax rate anyway, but I guess what I'm saying is if you get a 6% or 5 or 6% cut in the tax paid by companies, that gives you that sort of it actually gives you a little bit more than that in terms of earnings growth, because if you earned $100 and then you pay tax, so now you're getting $79 and you're about to go to 85. That's closer to a 7% return. Plus, you get a bit more. They're let up on regulation, and there's all this. There's a lot of antitrust stuff going on at the moment that will probably go away, and so companies can then fatten their margins up a little bit again. You could add easily 10, maybe 15% to earnings just on those two alone. And so you look at the earnings figures we're getting, and you look at the valuations and you go, yeah, the valuations look stretched. And you say, well, yeah, what happens if I added 15% to that? And to the earnings, you say, oh, well, okay, well, in that case, you can bring valuations down to expensive, but not sort of not at never before seen levels, I guess is where I'm getting to. And so that's on the big picture. On the Trump, yeah, look, I mean, I think you need to take a lot of the stuff he says. Look, I think our take is, look, he does tend to follow through on his promises, but maybe not as far as what he says. So if he says there's going to be 100% tariffs or whatever it is somewhere, there's going to be tariffs that are going to be higher than what they are now, but they might not be as high as what he says. And if he says he's going to build a 10-foot wall, well, he's going to try and build walls, and he's going to try and crack down on immigrants. Whether he does build that wall or not build that wall, he's going to move in the direction that he says he's going to move. And some of this is for negotiating purposes, I think, in terms of certainly some of the tariffs is, I'm going to whack a 25% tariff on Mexican imports if they don't do whatever. And then, there probably will be a tariff, but there'll be some sort of negotiation, and he'll get a bit of what he wants, and maybe the tariff won't be quite as high as expected. So that's the way we're sort of treating it. In terms of individual companies, we're very much looking at mispricing and the ones where we think that markets are factoring in one thing. And I've spoken before about some of the renewable energy stocks in particular that really got smashed in terms of Trump putting in. Last time around, Trump was pretty good for them. And, arguably, if you've got a lot of operations in the US and you're running some of these renewable energy things, then having large tariffs on China is going to be better for you than anything that Trump's suggesting he's going to do to that sector. And so, I think it's more about, I don't think, you won't get as many benefits, but a lot of that's already locked in from the Biden, subsidies. And it's probably more of a relative game in terms of saying, well, some of the negativity and some of the protections on oil and gas are going to go away, rather than him coming out and saying if there's going to be a 50% tax on solar panels or something like that. I'm not expecting anything of that nature. So that's one area we're looking for. Just that stocks have been beaten down because of one expectation, and we've got a view that it won't be as bad as what the market's pricing. And there's a lot of ones as well where we're selling out, where it's we just don't think things will be as good as what people have priced in for Trump's will talk the game, and energy stocks again is an area where I think it'd be quite good for the production of energy, and I think he has got the idea that he wants to keep prices low and help get production going as much as possible. But that's probably a bad thing for the price, and may not actually be good for all the companies involved. And so depends on whether they're going to be ones that benefit from the ramp up or not.
One quick question. Stronger dollar, presumably as a result of all of this, and therefore a weaker Aussie dollar. And of course, if you look at the Aussie dollar now, it's down quite a long way from its peak up in October. That, of course, has a significant impact in terms of thinking about investing in Australia versus in the US.
Yeah, absolutely. It's interesting that I think Trump has talked about having a weaker. He spoke for a bit about having a weaker dollar, but most of his policies are a strong dollar, and it does seem as if I don't want to underestimate his view, but it does seem as if he likes the idea of having a strong dollar in certain cases. In other ones, he complains about other people, weakening their currency too much, but in other times I think he just came out with a statement about complaining about BRICS trying to move away from the US dollar or something like that, which is clearly if he's trying to threaten people to keep them on the US dollar, then that's a strong US dollar policy. So if you're an Australian, and probably the bigger thing to worry about for Australia is all the tariffs and protections you can put on China, and the effect that that's going to have on the Aussie dollar, I think is just as great. So I think Australia certainly sits in that case of saying, not only are we looking at a stronger US dollar, but we're quite possibly looking at a much weaker Chinese yuan, and that's going to have flow-on effects for the Aussie dollar as well. So sort of getting it from both ends. So international investments are good at that point in the cycle. We've got sort of, I don't know, maybe more than twice as much in international relative to Aussie than what we in terms of the investments we've got.
So just in terms of that, so if I'm an Australian investor sitting in Australia, I'm looking across at the US, and I'm looking at the weaker Aussie dollar. How do I play that in terms of, do I try and get into the US? Do I wait? If I'm already in the US, then I'm going to do well. But if I'm in Australia, that's going to be a problem, isn't it?
There's always a question at this point about, and I face it all the time with people who are saying, I've been sitting on the sidelines for years. Markets keep going up. I keep thinking they're going to crash. I'm just going to keep sitting on the sidelines, and I'll hope one day I'll be right. And there's people I know who've been saying that for 10 years or 15 years. I think there's a point, and actually I'll jump into, I've got a chart on one of those, I'll show in a minute. I think you need to be thinking about averaging in at some point, and at least having some exposure from an Aussie investor's perspective. International investments actually work quite well insofar as when the markets, when the world economy goes well, then Australia tends to go well and the Aussie dollar goes up. So what we're talking about there is, say, you're looking at international markets are up 15%, but maybe the Aussie dollar is up 5%. And so you're actually only getting a 10% return as a net return. But the reverse also works. So when we see world growth slacken off, and particularly commodity demand and things like that, and so you might see equity markets take a tumble, is usually that coincides with the Aussie dollar falling as well, and that then offsets your losses. So during the pandemic was a great example. Pick whatever time frame, but you might have seen markets down 20%, and the Aussie dollar fell 10 or 15% at the same time. And so if you had invested there and your market's down 20%, but the Aussie dollar is down 15%, well, you're actually only down 5%. And so as an Australian investor investing internationally, you actually get a bit of a buffering effect, or not a bit, a large buffering effect from those. And the flip side is, people investing in Australia look at it the opposite way. It's supercharged, because when things go badly, Australian dollar goes down and the Australian market goes down, and vice versa. When things go well, the Aussie market goes up. And so that's where, that's sort of explains part of the excitement for Australia, I think, is that there's, often Australia, I think, gets bought on the back of going, well, if I've got an improved view of world growth, I should just go buy Australia because the Aussie dollar will probably go up and Australia will go up. And I think that was part of what's driven the strength in the Australian market post-Trump, but it hasn't been enough to offset the falling Aussie dollar. So, yeah.
Other point, of course, is that China is perhaps hard to invest in, but Australia is sometimes seen as a proxy for investing in China. And if China is going off the boil and the exchange rate moves against us, then we get almost a double whammy.
Yes, exactly. So, look, to my view, that's the biggest thing facing Australia over the next few years is during Trump's time is how hard he goes on China in terms of tariffs and what the effect is on China. Our expectation is quite a lot. I think there's an argument out there or a hope out there, I think from a number of people that things will be so bad that China will have no resort except to go and try and reignite a property boom and go and therefore spend lots of money on iron ore and go through that whole process again. And maybe that's right. I just don't think so. I think the more we see from them, the less likely they are to want to do that. The more they're seeing the actual the problems of this property boom, and the more they're trying to reinvest in sort of industries of the future, whether it be electric vehicles or solar panels or whatever it is in terms of semiconductors, where they're trying to throw a lot of money at that. In some areas they'll be successful. I think a lot of the sort of lower end ones they'll be successful, and then on the other side, the higher technology ones, I don't think they'll get there, but I guess it's one to watch.
Yeah, and it's worth noting that the government stimulus in China, particularly helping some of the states and other state entities, has been to try and sort of prop up property a bit. But the quantum has been quite small. In fact, markets have been saying, "Oh, we want more," but we're not seeing it.
Yeah, that's right. And God knows how many times we've been disappointed so far. Or people, I don't think it's come in well line with sort of what we've been expecting internally. But I think you seem to get this run up in the iron ore price in particular when new announcements are coming, and then they tend to disappoint and it fades off, and then you get another rally when the next one comes out, and there's always a speculation about how big it's going to be, but so far it hasn't. Not to say it will never, but our expectation is that the bubble's big enough there, and they know it, and they can't look at it. And I don't think they even wanted to do it during the pandemic, but they felt like they had to. I think that was the part where they were, they had their 3 red lines already, where they were trying to slow the property market down. Pandemic happened, and they just went, well, stuff it. This is a big thing. We'll throw lots of money at it and push it along. And I don't think they wanted to, but they were forced. And I think there's a reasonable amount of traders out there that keep expecting that to happen again. And so, that'll be the key for Australia as to whether it does or not.
It seems to me one of the other keys, and moving on to bonds, because bond rates, of course, are higher than they were, is the US is going to issue more bonds, quite clearly. And who's going to buy them? And is China buying or selling bonds?
Yeah. Well, see, this is this part with the US dollar. Like I subscribe to the view that the imbalances are the Michael Pettis view of the world, which is basically that if you have countries that try to devalue their own currency or keep their own workers low in order to create more manufacturing, with the view that then they'll be exporting, they'll sort of grow their exports by keeping wages low and keeping their currency low, is that's the thing that actually ends up creating a lot of these deficits, is that it's where other countries are trying to force their extra production on the bigger countries. And so China's sort of this talk about saying, well, China's going to going to stop buying the bonds and all those types of things, and saying, well, yeah, but its problem then is it could end up crashing its economy, because then it's going to. So at the moment it's going, well, we'll sell $10 worth of goods to the US, and then so we need to buy $10, but we're not going to bring that back into Chinese yuan, and so the yuan won't go up because there'll be less demand for it. So their problem is if they want to get out of the US, so they've got to sell US dollars and buy Chinese yuan. If they're going to do that, they're going to strengthen their currency dramatically, and then they're not going to be able to sell stuff because they're not only will they have tariffs, but they're going to have this higher currency. And so the question then is saying, well, what if they go stick it in another country? Is saying, well, there really isn't another country big enough. They've been trying to do it a bit with Europe, and they're trying to do it a bit with Japan, but both those countries don't want it to happen and are actively trying to prevent it. Whereas the US is one of the few countries, well, arguably US, Canada, Australia, UK are the countries that are allowing other countries to sort of devalue versus their currency without sort of doing too much about it. And so that's, and none of those countries are big enough to take the flows from China. So China might not want to buy any more US bonds, but they're sort of stuck in that position about, well, what else are they going to do with the money? And do they want a stronger yuan? Because if they all of a sudden brought back $1 trillion of US dollars back into Chinese currency, that's going to send the yuan to the sky.
And another factor, of course, is oil, because oil prices have come down. The Middle East conflicts, although they're dramatic and hard to swallow, they haven't had a massive impact on oil prices. And now people are thinking, well, maybe China will be dialing back demand. US is continuing to produce even more, and under Trump will drill, baby, drill. So oil prices could be lower ahead, and that could have a significant flow-on impact then through to both economies and also, of course, to exchange rates.
Yeah. Well, and the other, I don't call it the bigger one out there as well is what happened with Russia. So if there is a negotiated truce to the Ukraine conflict, and I'm not saying that'll be just or fair or whatever it is, but if Trump comes in and basically says, I mean, that the expectation is that he'll basically publicly say to Russia, if you don't come to the negotiating table, then we're going to help the Ukraine even more, and so then turn around and say to the Ukraine, well, if you don't go and negotiate with Russia, then we're pulling support. And I think that's probably got enough to get the parties to negotiate. If that's the case, then Russia was one of the three largest producers of oil prior to the conflict. If they come back online and can freely push their oil back out, then that's one more thing that's going to push the oil price down. So it's probably going to fight against a stronger demand, I guess, but particularly from the US. But yeah, by and large, it doesn't look particularly good for oil. And so you can paint some pretty compelling sort of bullish stories where you say, well, we had a bunch of extra profits into the US economy and more from tax cuts and things like that. There's lots of stimulus going in from the US into the US market. Interest rates are falling, maybe not as fast as they would have, if they weren't doing all these things, but they're still falling. So you're not worried about a sort of tight economy and things like that. Then you add in lower oil prices and quite potentially lower energy prices, and there's a number of lots of grains that sort of from both the Ukraine and Russia that could then sort of bring food prices down a little bit more again. Like there's a number of things there you could sort of line up to paint quite a rosy picture for world economic growth. Now, a lot of that's already priced, but let's see. But yeah, there's you want to be open to different scenarios, and that's one more reason why if you're sort of sitting on the sidelines and saying this whole thing's going to come unstuck and it's not sustainable, well, there are certain things that aren't sustainable, but they might be sustainable for another 5 years or 10 years before they do become unsustainable.
Other interesting observation on oil is that if it comes down towards 60 or below, that's going to put pressure on Russia itself, because of course it's selling still some oil, and they benefit from higher oil prices. So lower oil prices actually doesn't benefit Russia.
No, but no. Well, it's a price and volume. Yeah, it's a price and volume game. And the question is, will they be able to put extra volumes on? And yeah, there's a whole bunch of questions around that. But I think there's certainly there's a certain amount of premium in the oil price because of the Ukraine conflict. I think that will come out, or has potential to come out. And that's a good thing for everyone in terms of, the rest of the world all of a sudden it has just that little bit more money to spend on other things.
Yeah, and very interesting. So, if I sort of stand back and just think about all the stuff that we've been talking about, what we've really said is that there's a lot of complexity, quite a lot of change. Also, there's a lot of people sitting in cash at the moment. And it's interesting that some of the surveys showed that more people were still sitting on the sidelines than engaging in the market. Now, it's an interesting situation with so much cash sitting out there, watching and waiting and wondering what to do, right?
Yeah, that's right. Is that going to drive the market higher? So, I mean, I'd describe ourselves as being nervously fully invested at the moment. We have, for, I don't know, 3 or 4 months now at least, and even before that, we were pretty close to fully invested. But yeah, we've it's sort of one of those markets. It's a hard market. And I've got this, and I think I might just can I just jump back to that Shiller PE and talk valuations, because I think that probably might give people this view. I'll show you where the Shiller goes. So Shiller's got this idea. I've sort of got this illustrative chart up to sort of showing if there's a blue line of unadjusted earnings per share, and then the blue dotted line is your 10-year average. And then what Shiller does is he says, well, the earnings from 10 years ago isn't worth the same as the earnings from today because you had inflation. So I'm going to take those earnings from 10 years ago and put them up a little bit to account for inflation. And so I get this new sort of higher line, which should give me this sort of 10 years as, it's relatively arbitrary, and he'll admit it as much, but, it's this idea that I've got this earnings that I should be able to expect despite ups and downs. But the problem with it is, if you look at that if you just took an average and you said, well, what's the average been? The average is sort of 15, and you've had one chance in the last 40 years to buy. And I think that's where I think a lot of people, look at these and they look at these numbers and go, wow, the only time it's ever been higher is during that financial crisis. And so that's, that I just need to sit on the market and wait for the whole thing, sit out of the market and wait for the whole thing to come unravel. So I've got a whole bunch of changes though that I make to this because I don't think they're doing it right. So first of all is that idea that what it should be is the tax rates that you're the current tax rate. So people aren't looking back at earnings from 10 years ago and say the average was say we've been earning 100 the whole time, and so 10 years ago there was a 35% tax rate and you're only earning 65. People aren't looking at that 65 today and saying, oh, we'll get back to that 65 at some point, because tax rates just they're not looking like going up from 21 to 35. They look like coming down. And so if we flip that back around and just said, take the pre-tax numbers and do that, then I do the buybacks. And now all of a sudden this cyclical PE comes back to sort of high 20s, and you look at that and go, well, okay, so it's much lower than what it's been in than the sort of raw numbers, but it's still pretty high relative to history. And that's what I call the sort of Shiller 2.0. And then there's a whole bunch of other things though we can adjust for. Now, accounting standards aren't the same over time. That's the first one is it used to be that people would go towards write-downs, like in the 1960s and 70s, if you wrote an asset down because you had a downturn and then you have an upturn, you then write the asset back up again. So you had there was two ways, and that's no longer the case. Now everything gets written down and it's very, very hard to write it back up again. We used to have goodwill amortization that's no longer there. You can also adjust for sort of the real tax levels rather than the statutory levels, just because companies tend not to pay they tend to pay a level below that. Depreciation is a fascinating one with higher inflation. So we didn't have enough higher inflation in this period to really see it happen. But if you're building a factory, say, and you spend $100 building a factory, and you're going to depreciate it over the next 10 years at $10 a year, and then in 10 years' time, you're going to build a new factory. There's this idea that, well, in 10 years' time, it's not going to cost me $100. It's going to cost me more than that. And so maybe it's going to cost me, $120 to buy that, to build that factory. And so while I'm depreciating $10 a year, maybe I should be really depreciating $12 a year. Like there's some higher number that depreciating sort of is understating what the earnings are. Well, then when you get these really huge levels of inflation, like you did in the 70s, that gets out of control. And so the depreciation, they actually went to companies in the late 70s. They went out and surveyed a whole bunch of companies and to say, well, if you used replacement cost rather than depreciable cost, what would your earnings actually be? And the earnings were almost were more than a third lower than what they were reporting. And the market knows that. They understand that analysts that routinely would adjust for these deflation numbers. And so they knew the earnings were overstated. So when you look back in the 80s at these numbers where you say, the 10-year price to earnings ratios got to sort of below 10 times, well, they did on a numerical basis, but everyone knew those numbers were overstated. And so you get the other, and and then the other thing I go through and adjust for as well is saying, well, when you were buying a stock in 1950, it cost you 1% to get in, and you had to pay, another 0.5% to 1% in the spread just because the distance between the buy and the sell was so large. You're probably getting 1 to 1.5% less return than because of all the costs involved with trading it, and those costs have disappeared now. And so if you sort of went and people recognize that people care about the end money that they sort of get. So if you go back and adjust all those numbers, all of a sudden you get this red line rather than the blue line, and that sort of lifts a lot of those, particularly those really low numbers you saw in the 80s. And what it turns this 29 into is, well, yeah, it's more than history. It is higher, but it's been there lots of times before. It's been there, it was there in the 2000s. It was there right throughout the 1950s, 60s, and into the 70s. And just before the Great Depression, it was there, but it was back there around 1900 as well. It's not completely atypical. So I guess what I'm saying is take the raw numbers, and it looks terrible. We've only ever once been this bad. But if you go back through and adjust for all the different accounting standards and a lot of other changes to put things on a more like-for-like basis, I think you'll find that across a whole range of measures, the market looks expensive right now, but it's not at sort of never before seen levels. And I was going to show you one other chart.
Just on that. So what you're saying is that once you take account of some of those accounting changes and everything else, the potential upside from here is not so extended as most people have been saying. In other words, there's more chance of more upside than many people are currently thinking. That's a really important observation.
Yeah. It's saying it's not. Yeah, one thing would say, we've never. Yeah, one way you look at it is we've only ever been here once, and that was just before the greatest, one of the biggest crashes we've ever seen. And versus saying, no, actually, this is, it's high, but it's been there lots of times. And actually, if you look back at the Shiller, so if you put that on a scatter plot, you say where this is a little bit different, but I'm looking at the excess yield now. You can reverse that and turn it into a yield, and then you can compare it to the bond yield. And so say, okay, so if you think about it like the yield on the stock market in a way, and so when the yield on the stock market gets really low, that's on the x-axis. What do you get out of the next 10 years? And so there is a sort of straight line relationship. So the higher the cheaper you can buy the market, the better the return you're going to get. The better return you would expect to get. But the relationship's like 33%. There's plenty of times where you could have bought the market on a 10% Cape yield, excess Cape yield, and ended up with negative returns over the next 10 years. And there's times we're at sort of about a 2% yield at the moment. So there's so the range of outcomes on a 2% yield is somewhere between 10%. Now this is a 10-year return, so annualized every 10 years. So 10% per annum for 10 years, or as low as -5% per annum. So it's a broad range. It's it's stacked a little bit against you at this point because it is more expensive, but there's plenty of cases where you got pretty reasonable returns from stock markets from these pricing levels. What I was going to pick on then as well is this idea of the forward earnings at the moment. And so that's what I was saying. So we're at probably close to the 90th percentile on this at sort of 21.7. This is a global amount. The US is a little bit higher and Australia is a little bit higher again than that. But there's two sort of parts I want to put into context. One is if you get that sort of 10 to 15% increase in earnings from where we are today through to tax cuts and some extra, the other spending ones. And look, I think 10% is conservative. You could easily have cases for 20% or more. If we're really going to run up the credit card and push a lot of stimulus, then that 10% brings the 21 back down to under 20. And so now you're back at the sort of 75th percentile of outcomes, which, it's expensive still, but it's not never seen, this is crazy levels. How can it possibly be here? And the other thing to note is, when were we there last? Well, the last time we were there was post-pandemic. And the returns were really, really good, like from these same levels. And what forced the market, what forced this down wasn't the market falling by and large, it was earnings increasing. So there's two parts to any earnings story, any valuation story. What's the valuation? And in this case, we're using price to earnings, but there's lots of other ways to look at this as well. But we'll just use this one as it's the most common. And then the other side is the earnings. So if your earnings booms, then your valuation will come back quite quickly. The prices can go nowhere and all of a sudden start looking much, much better. Yeah, the other things to note is, global at 21.7, US 23.7, a fair bit higher, and the Australia 24.3. So Australia is up there. We're expensive. Yeah. And that's excluding financial resources. When you go back and look at our banks versus other people's banks, like our banks are just like, our banks are at never seen before levels relative to other banks, particularly Commonwealth. We're just crazy expensive relative to the rest of the world.
Well, Commonwealth just announced charging people to withdraw cash out of machines or from the branches, right? So, and another move that will actually rile more people. The war on cash continues, and it's interesting that CBA, still massively profitable, is still trying to turn the dial even more so. But everyone is saying that the banks in Australia are way, 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 way overvalued. John Mott said they're double what some of the investment banks in the US are. Yeah,
absolutely. If you just Google and Meta, you can end up with looking at Commonwealth Bank more expensive than them, saying it's got better growth prospects. It's there's. I haven't got this chart, but I've shown it a few times on this channel. Just the one that says, if you break up markets into what do they do? What are they really doing? So, if you're a bank, what's a bank for? Well, it's there to provide capital to other companies or individuals to go and do, important stuff. And so, you're meant to be there you're a helper in the economy. You're not somebody who's actually going out and creating new things. And then you say, okay, well, then you've got what else? What other things are helpers in economies? Well, toll roads and real estate trusts. So property is it's not, once somebody's built a property, collecting the rent on it is not adding to anything. What you're there to do is you're there to house companies or house whatever, individuals and help them grow the actual economy. And so you sort of have these sort of rent collectors or toll collectors that sort of makes up that part of it. And then you add in resources as well. And so if you look at all those parts of the economy, most other economies, it's sort of 10, 15, maybe in extreme cases, you get to 20% of the stock market will be made up of those sort of ticket collectors, and the rest of the companies are the ones out there actually doing stuff. In Australia, it's the other way around. Like we've got 2/3 of companies on the ASX are in that category, and only 1/3 are at the actual ones that are out there, trying to create new products and grow the economy. So yeah, it's we have a different market to what we get elsewhere. One more reason to look offshore in terms of what you're investing, just to get a different sector mix, and that flows back through as well to people talk about the dividend yield. How you can get a much better dividend yield on the Australian market. Well, if you went out and you said, okay, I'm going to buy 60% banks, resources, utilities, REITs, all that type of stuff like that in the US or Europe, you'll end up with a yield much closer. Not quite as high as the Australian one, but it might be 10 or 20. It's within shouting distance of it. So part of the reason you're getting a higher yield in Australia, or a biggest part of the reason you're getting a higher yield in Australia, is because of the sectors you've chosen to invest in, not because there's anything magical about Australia. And I've said it again as well, but I'll repeat again that if I was an advisor in the US and I went out and I told my client, I'm going to stick you into 40% banks and 30% resources and all these REITs and all this other stuff like that. If that portfolio goes down, I'm losing my job and my license, and I'm getting sued by the client for that type of extreme portfolio construction. Whereas that is the Australian market. That's what we've got. So that's what everyone invests in.
So George asked this question: are you of the opinion, Damien, that the S&P won't correct soon? So you still think there's more upside? What do you think?
Well, yeah, we're fully invested. Look, do I think it's risky at the moment? Absolutely, I think it's risky. But there's the fundamentals are getting better at the moment, and so what we're looking at is you're going to have something. So you're at this more extreme valuation levels, and we're going to need something to knock it off the current course, and that's going to need some sort of financial crisis, pandemics, a big outbreak of war. Something could knock it out. We're in a precarious position if one of those things happens. The flip side is the fundamentals for earnings. We just went through one of the best reporting seasons we've had for 2 or 3 years. We're about to have Trump, give us all these tax cuts. He's about to throw open his checkbook and spend money everywhere. He's about to stop, regulating companies and stop worrying about what the price rises are doing. It's a pretty the fundamentals, look pretty good. So it's a matter of, as I said, we're nervously fully invested. So we've sort of got maximum weights or close to maximum. Oh, sorry, got more than benchmark weights, not quite maximum, but we've got more than benchmark weights in most equities, and we're trying to work out what's going to go wrong. Will the US correct? Yeah, look, it might. But you could say that anytime. And I think certainly over, if you're looking forward over 2-3 years, unless we see something that really knocks those fundamentals off place, then we're going to be investing, to what we can. If we saw a big pullback in the US, we'd be taking some more money out of bonds and putting them into equities. Sorry, subject to what the reason for it is. What's actually been working within markets, with the Trump trade and what hasn't been. And so what's most interesting sort of post the election is there's been a sort of a relatively big reversal in some of the trends we've seen. So there's a number of different quantitative factors that we look at. And the most common ones are earnings quality. So what you're looking for is companies that make the bigger margins and companies that have solid returns on equity and returns on reinvestments and things like that. So that's sort of a group of companies, and they sometimes do well and sometimes do poorly. What was interesting is they did really well in the run-up to the election, and particularly as Trump started to become more likely to win. And then as he won, they've actually reversed and come back quite strongly in the month of November. Analyst expectations was probably one of the biggest ones, and historical growth. So it's been this real growth focus of looking for companies that are either upgrading their earnings or have had strong growth in the past. And we had this big reversal in what's called price momentum, which is what went up recently. And so that's the one that it was quite interesting that this sort of reversal of the companies that had been successful. So it's and when I'm talking about this, I'm saying it's been more. It hasn't been that those companies have necessarily fallen a lot. It's been that a lot of the laggards have really taken off in this past month, past Trump. And the interesting part for me is that Europe is just completely different and remarkably so. So usually there's a fair bit of correlation between these trends. So they won't be exact, but when quality is working in US, it's often working in Europe. Another factor is valuation. So you're just buying the cheapest companies, which often tend to be quite low quality companies, but not necessarily. But the companies that are the cheapest. Sometimes they do really well. Most of the time, they actually do badly, particularly in recent years. And what's interesting is that Europe and the US have just been chalk and cheese on all these measures. It's like you're looking at two completely different time periods where just the order of what's working in one is excluding analyst expectations is quite different. And so it's throwing up, certainly on our measures anyway, it's throwing up lots of interesting opportunities of stocks that are just stocks and sectors that are falling while their compatriots in the US are rising, or vice versa, and just sort of that idea that you can look for certain types of stocks and just get completely different pricing depending on what country you're in. And I guess it might be fine to have those differences when you're talking about stocks that might be purely in, say, France versus a stock purely in the US, but that's not the case in large cap stocks. And that's what we're looking at is most securities are global in nature when you're talking about the stocks that are traded. So it's your CSL is notionally an Australian company, but really it's a global company. If you talk about Unilever, well, it's listed in the UK, but it's a global company in terms of and UK and the Netherlands, depending on where you want to buy it. So McDonald's listed in the US, but it's got worldwide operations. So when we see sort of these differences, quite often we can look and say, well, what can we buy? Can we get exposure to what we're mostly looking for is, can we get exposure to the US without having to pay up for the stocks in the US by buying stocks that have lots of US operations but happen to be listed somewhere else.
Yeah, very interesting. Now, it's interesting that Bosman bowled you this little question, which I'll just put up on the screen. Outside of housing and digging stuff out of the ground, what's the Australian outlook? Which is sort of goes to where are we and where we're heading in Australia. I mean, the inflation rate is still relatively high. Interest rates look to be sticking higher than people were thinking. China, as we mentioned earlier on, is going off the boil. The latest measure of the overall complexity of the Australian economy has dropped even further. We're now way down the list compared with most other Western economies. So I guess the question of growth and where value creation will come from is quite an important one for the Australian economy.
Yeah, that's right. So I mean, the big one is China. Like that's what have we got outside of those? Well, we haven't got much of a manufacturing sector, and actually, what we have in the manufacturing sector is squealing like mad at the moment because of how high we've allowed energy prices to go. And I know you talk about that here, Martin, but Australia is one of the top 3 energy exporters in the world. We should have low energy prices. There's no reason not to. Every other energy exporter does. Every other energy exporter either puts domestic reservation or whatever it is to the US up until recently just had an outright ban. You couldn't export oil from the US. It's just nuts. And so so we've basically shot ourselves in the foot on that one. So we're not going anywhere on manufacturing. what else have we got? Services. Well, look, I think we need a much lower Australian dollar to sort of start generating some other industries. So it's not to say we can't do it. Australia's got a very knowledgeable population. It's got the ability. It's got the there's nothing. We've got a legal system that's very much geared towards helping companies grow and all the things. We just don't have a political system that's that way. Our political system is enamored with the view that we're a small country, so we need a few big companies to reign over us and to have duopolies and oligopolies and things like that. So I think some of the best performers. I haven't done it recently, but it's probably 4 or 5 years ago I last did it, where you looked at the best performing stocks over a whatever it was 20, 30 year period in Australia, and you basically ended up with all these companies that were either monopolies or oligopolies, or had some sort of relationship with governments that might have close regulatory regulation rather than out there doing innovative things. So ideally, we'd be full of ResMeds and CSLs and companies that are out there creating new things, but it makes it difficult when the investment dollars are all being sucked into resources and banks.
Yeah, and as this particular comment talks about, we have a convoluted financial investment system in Australia. We also have massive lobbying from those big, powerful corporations, which have been given way more tax breaks and tax support than they probably should. If you look at the relative tax take from the household sector versus corporates, household sectors continue to hit an all-time high, corporate section not so much. So we have a structural issue with regard to the way that tax is taken. We have a structural issue in terms of the narrow base of our economy, and we have this huge reliance on just a few large companies, corporations overseas. China, a big country there, a lot of our stuff goes up to China. But if you look at what Australians are paying for everyday goods and services, on an average level, it's a lot higher than in most other countries. It's true for banking, it's true for airlines, it's true for retail. So we actually are in the situation where it's households that are paying through the nose through this narrow base in Australia, which is why I would argue that on one hand, corporates are doing quite well and their returns will probably stay quite high, but it's at the expense of households.
Yeah, absolutely. No arguments there. And that's I guess it's the reason to try to invest is saying, well, you can certainly try and work against the system, and I encourage people to try and get some more fairness into it. But both parties are beholden to helping corporates out. I mean, it's not a huge sector I suppose it is a big sector, but so one I'm intimately involved with is superannuation, and we've spoken before, I'm sure, about the amount of money that goes into superannuation, tax benefits, and the amount of money that goes. Like basically, if you said, okay, I'm going to take all the money that we're paying to super funds, I'm going to take all the tax breaks that we're giving to super funds, and the transaction fees and all that type of stuff like that, you could easily fund this, world-class retirement system. Like the amount of money we're pouring into it in that we're sort of giving up, I guess, as a government. So, and then they complain, oh, look, the fees are too high in this sector. And they say, well, how are we going to fix the fees? Well, we're going to make all the companies consolidate. We're not going to allow new ones, and we're going to make all the existing ones consolidate. And you're saying, well, what other industry do you out there and say, what we need is less competition. The prices are too high, therefore we need less competition in order to bring prices down. And so, anyway, and that's because the unions are very close to the one side of the government, and the retail funds are very close to the other party. And they both talk about saying, oh, why don't you let us go buy all our competitors, and why don't you let us, we can increase management salaries, and we can get more directorships and pay more for directorships and things like that. which may not be in the best interest of of consumers. So.
Yes, the old consumer who's at the end of the chain. And it's worth just going back to the US election. The US election was won by Trump because he focused in on this big question: are you better off now than you were 4 years ago or not? Right. I suspect that that'll be a bit of a discussion that we're going to have in our upcoming election too, except to my mind, both sides of politics have the same policies pretty much. And so there isn't really much between them. So I'm not sure that there is a, are you better off or you're worse off? The truth is we're all worse off. You look at what the tax we're paying now, we look at the growth of income versus, other things that are going on. And so structurally, we have a major issue in Australia. And
and I'd say, I'd argue that the last, the reason the Liberals lost the last election was that, there was a case made for change and a case made that we need to be doing things differently. And it's difficult to really put your finger on what it is that we are doing differently. There's, some minor changes, but by and large, it's the same policies, and some of them are, some of them flipped around from, I think that, when in opposition, the Labor was talking about reducing the amount of immigration, and they've been running it at record levels. And so, it is difficult to see under which, regardless of who you vote for, whether we will see too much major change either way.
And it's interesting because, of course, the $3 million and above superannuation tax on assets didn't actually get up in the end of the year, as I understand it. A lot of other stuff did, but that one didn't. In the UK, there's now a much more of a focus on taxing assets rather than actually taxing income. And I suspect that at some point there's going to have to be a conversation in Australia about asset values and asset taxes rather than just income taxes, because there is no capacity for the Australian economy to generate the income that it needs unless, as you say, they give up all the tax breaks to corporates that they're handing out hand and fist at the moment. That's a structurally very important change. To my mind, we should be asking harder about where our taxes are actually going, because there is quite a lot of money being created, but it's not going in the places that we probably would want to see it going in.
Yeah. Oh, look, absolutely. I mean, I think I'd love to see an argument around the whole idea that's saying, well, I take an average 40-year-old who's earning $100,000 a year, and look at the amount of tax they're paying, and then I turn around and say, well, now I take a 40-year-old who just, who's retired, inherited a $5 million house from their parents and sold it and living off $100,000 of investment income, and look at how much tax they're paying, because it's chalk and cheese, like the amount of tax breaks, and you're getting capital gains discounts, and you're getting franking credits back, and all this stuff like that. Is you're turning around and saying, well, the guy who's working and earning the same amount should be paying 2 or 3 times the level of tax to the guy who's not. And so I think there's plenty of things there, but Australia's just not going to make any changes. We've suggested a few. It's been suggested a few times, and then every time there's a suggestion, that gets shot down and lost in the lost in it. I think there's. I don't think either party has any desire to put anything radical through. I think that desire to talk like some of the things they're doing is big and important, but I think there's it's a hypothetical 50-year view to put in some more nuclear power, and over the next 3 years I'll do almost none of that is an easy policy to have. Might sound like it's daring and different and all that type of stuff like that, but is not much. And I think it's or to have plebiscites on various things as constitutional change is well and good, but is really not doing anything. That really haven't made any changes to it's almost be called a red herring to say, well, it's your bread and circuses. Hey, look over here at something interesting while we stuff up a whole bunch of other things on the economy, or help out our mates somewhere else.
misdirection, it's called. Look over here, that's where all the funny stuff is. But over here, that's the stuff where you should be looking at.
That's right. And guaranteed. Well, there's a lot of complaints about. There's all the stuff about which gender should be in which change room, and all this stuff like that. And look, for some people that's extremely important, and it is, but in the whole economy, it's clearly a misdirection, and being used as a misdirection by the parties involved to ignite their, worry about that. Don't worry about how I'm going to be giving big tax cuts to corporate donors.
Now, there was a question that was thrown in the chat earlier on, which I didn't want to bring up earlier on because it was not necessarily in the flow, but here's it. If you've got cash, where is the safest place to park cash at the moment? Now, there are some people looking at the bond market thinking, oh, that looks pretty good, 5% returns. You can get term deposits, still 5%. You can get annuities, or you can just stick it in the bank and, hope for the best. When you come across one of your potential clients with a significant cash pool, what's the conversation that you have with them?
Yeah, so this is the irony of cash, is that, and why bonds, it's probably worth having a look at bonds. I'm just going to pull up some of the latest prices just to make sure I'm talking the right numbers, and things haven't moved this afternoon when I wasn't watching. But so it's this idea that's saying, well, look, I'm really worried about the market or the economy, and I think things are going to go badly, and so I want to just leave my money in cash. Now, there's if this is a short-term trading strategy, then that might be a good idea. If this is more of sort of a long-term view that, no, actually, I'm really worried about the Australian economy, and I think things are going to get worse over the next 5-10 years, then effectively what you're saying is, well, I'm going to put my money in cash, and then because things are going badly, if you get it right, things are going badly, then they're going to be cutting interest rates like crazy. And so I'm actually going to end up back where we were in the 2015 to 2020 sort of range, where cash was giving you nothing. And so I guess what I'm saying, I say to people who have got that, if you want to lock away returns, buy some government bonds, and you can get a 10-year bond at the moment and get 4.4% almost yield on that for the next 10 years. And I've had conversations with clients who have said, you know what, if I can get a 4.5% yield that you can get on a 15-year bond, if I can get 4.5% return for the next 15 years, it's guaranteed by the Australian government. It is an Australian government bond, so then they're happy. They're happy to say park a reasonable proportion of their money into that, and say, I'll take 4.5% yield for the next 15 years, and then I can forget about it and get on with my life. Whereas the problem for other people is saying, well, if you go down the route of saying, well, I've got my money it's all in cash and I'll be fine, but then then you do run into problems where interest rates start getting cut, and you end up back in that same sort of position we saw pre-pandemic, where interest rates were pretty closing in on zero, and you just weren't getting that return on that anymore. And so so that's where I'd be pushing. And then the other thing I'd be thinking about as well is, if you buy a bundle of equities and you're getting that dividend yield coming out of that, and that dividend yield is growing at a reasonable clip, and it does tend to grow at a reasonable rate, sort of 5 to 7% per annum, is sort of the longer term returns. So it's very similar to the earnings. We saw the earnings were growing at 6% per annum. And so you can get a very similar return in terms of your dividends growing at that rate. Well, how much do you need in terms of markets? And if you're not watching it on a day-to-day basis, but say you've got $1 million in the market and you're getting $40,000 out of that, and that $40,000 is growing at the rate of inflation or above, then do you care if the million turns into 1.2 or if it turns into 800,000? Well, if you're not selling it, if you're taking the dividends and that's then it's less of an issue. And so longer term, the bigger danger I think for most people, and particularly now, I say, is it's the thought of saying, if you're worried about the market crashing and you think things are bad, have you got absolute certainty that's what's going to happen? And if you haven't got absolute certainty, then you probably should have at least something invested in the market. And that's, I think, the way we tend to try and run out. The way we try to run out a lot of our portfolios is saying, well, yes, we want this thing to go up if we're right. Let's try and position it in the right assets. But just as importantly, we're trying to look and say, well, if we get things wrong, we need to make sure we're limiting the downside. And if you're sort of sitting here saying, look, I'm going to sit, I know plenty of people for the last 5, 6, 7 years have been sitting in cash and saying, no, the markets are too high. They're crazy levels. They're going to have to come back. And, we popped up that chart showing you that for the last 10 years, we're up 13% per annum in the US. It's just been, and the US, Australia is not that far off. And it's just been that one of those environments where, could we see another 5 years of that? Sure. If you're happy to sit out that 5 years and not worry about it, then be comfortable in cash. But I guess my exhortation to everyone is to try and have a diversified portfolio, and there's no absolutes. You should never be 100% equities. You should never be 100% cash. There's a range of places in between.
Here's a one that follows up quite nicely from that, which is Jolene here. When do you think the RBA will cut rates? I mean, who knows? But what we can say is that Michelle Bullock has been quite clear about the fact that the cost of living support, like from electricity and other things, she's looking through those. The underlying inflation is still a bit sticky, much stickier than in many other countries. And she's now saying that she's not going to get back into an inflationary band until maybe 2026 or whatever it is, which suggests rate cuts probably not until sometime next year. And May is where a lot of the banks are now sitting. Some are suggesting no rate cuts next year. And that's an interesting observation in the context of what we were saying about cash. How long will rates stay high? I think the big question is, are we going to get an external shock of some sort? And if we do get an external shock, then remember, rates will get cut again, just like they did through COVID. So that's the problem. Nobody quite knows. At the moment, I don't think I see a path to rate cuts anytime soon.
The RBA is not talking like they're going to be rate cuts. I think they're wrong. I think there's a number of economists. I think Adam Boyton from ANZ and the CBA, Gareth Aird from CBA as well. I think both of those guys written some stuff which I agree with recently, and so basically, the RBA is saying, well, at current employment levels, they don't think that that's conducive. They think we've got too many people in work, basically, so many people in work that's going to keep inflation levels high, and I think that's wrong. I think that we can handle lower inflation rates. And I think a point at wages growth. Wages growth is not high in Australia, and it's never been. It popped up a little, but compared to the countries like the US or the UK, like our wage growth just hasn't done anything, and that's a lot of that's to do with the level of immigration. But regardless, it's showing that I think that's the sign that there's no real pressures in the wage market, which is causing inflation. I'd point back to energy, absolutely, and it's a self-inflicted one. There's other, and I think there's a lot of imported costs we've had. I think we'll see as China, if China really does start to get hit, then that's one or more area I think we really will see some pain. So I'm sort of more nervous about the Australian market than I am global markets. I think Australia is more at risk in terms of interest rates, and we run a few sort of hedge fund type strategies for some clients, and within those strategies we've been sort of taking the view that that the RBA has got it wrong, and that we'll see some rate cuts in shorter, but far earlier than what they're expecting. We could be wrong, but I guess that's where we're putting our money is on that. The rate cuts will come earlier as China slows more than expected, and the Australian economy, just doesn't go anywhere. Keeps just glide path down with the worries it'll get knocked off by external events.
And it's worth saying, isn't it, that the RBA has a habit of saying one thing and then doing something different. I remember Phil Lowe saying no rate rights until, way down the track, and then bingo, they put rates up. So they will change. They will change.
Sorry.
They will change.
Yeah, and the other thing that they're saying about looking through the energy prices is that I sort of look at that and go, well, I mean, it is possible that the energy cartel keeps charging us, outrageous prices forever, but there's also the case saying, well, they'll come off. They'll either get extended if energy prices remain high, because it's a bit of a bribe to the population, and better for people not to see those energy prices coming through and blame the government. The flip side is, well, they could come off, but they'll come off if we spoke about lower oil prices, and presumably that flows through to a lot of the gas and other things as well. That's where they come off. So the RBA might be looking through it, but by the time they've stopped looking through it, and by the time they actually do roll off, it's quite possible that energy prices are back down.
Absolutely. Well, we've pretty much come to the end of our time, and I'm pleased to say that the banging has gone to the other end of the house, so it's gone away a little bit at the moment. So I hope it wasn't too distracting for people. So I want to say, Damien, thank you very much for your thoughts tonight. As always, if you want to know more about what the World Funds does and what Nucleus Wealth does, there are links and things in the comments below. Very transparent set of tools there that are available to help you manage your money and create wealth, and a number of different options. Damien, you've got quite a pantheon now of different ways of helping people.
Yeah, so we've been adding a lot more tilts into this. So the idea is that within the portfolios, we have these core portfolios that might be an index fund, or it might be one that we're running ourselves. But what we've done is we've broken them all open, and you own all the individual stocks within it. So you've got sort of full transparency, and then you can knock things out and put things in. And so we've always had 30 or more things where you can knock out stocks to do with climate change, or stocks to do with war, or anything you like that, or to just pick different countries. And we've been adding in lots more on the other side as well now. So there's lots of little bits where you can say, well, actually, you know what, I'd love a bigger exposure to gold, or I'd love or gold stocks, or I'd like an exposure to the biggest tech stocks around, or semiconductors, or things like that. So it's just sort of giving you that part to say, yes, we're still running these portfolios in the middle, but you can sort of put some of the flavors you like around the outsides for you.
And I think that concept of the nucleus, so, at the center you have that solid proportion, but then you fiddle around the edge and you want to do things, then do, but don't mix the two up, because, this is about long-term wealth construction and security, not short-term trading.
Absolutely.
Thank you. Martin. Really appreciate that. I look forward to, now we're going to tee up, I think, a show on the 31st of December. So that'll be a sort of end of year special. And we're going to have a bit of a chatter there about what's happened and what may happen in the next year. So that'll be worth putting in your diary. So thank you very much for that. Look forward to that. Damien, really appreciate your time today.
All our resolutions ready?
Yeah, I've got mine polished and ready to go. Jason, thank you very much to the Super Chat as well. Really appreciate that. Thank you very much for that. And, there's be a lot to talk about, because the new year will be Trump getting into power. We'll have a read on whether the Middle East is actually going to settle down or going to continue to explode. We've got the European situation with regard to Ukraine and beyond. And, in the meantime, we'll see what the markets are doing. So I look forward to that. Damien, thank you very much.
Yep. Thanks a lot.
Okay, we'll see you next time. Cheers. There, folks, I hope you enjoyed that. Very interesting from Damien, as always. And, of course, some significant observations as to what's going on there. Next week, there'll be another show. I'll confirm the guest shortly, but there will be a show next week, even with noises off. And the dogs, well, they've hardly moved. The dogs are still here. They're just ready for a twitch. There you go. So good to see them still there. I guess it's time for lunch and then a walk out. So look forward to that. Thank you very much for spending some time with us. Take care. Have a good week, and we'll see you next week. This is Martin North from Digital Finance Analytics, signing off. Cheerio.